Okay, so like I said, everything that you've learned about depreciation for financial accounting purposes, forget about it. Depreciation, in financial accounting, we've got lots of choices with regard to depreciation, right? We've got, we could do straight line depreciation, we could do sum of the year's digits depreciation, we could use some sort of units of measurement depreciation, we could do accelerated depreciation. Like, we can choose what makes sense to us as far as depreciation. We also have a salvage value at the end, right? We're gonna assume that our asset is going to have a certain value at the end of the depreciation. And when we're calculating our depreciation, we don't include that salvage value in the calculation. For tax depreciation, we don't have any choices. Well, I shouldn't say that. We have a couple of choices, but they're very limited. And we have no salvage value. So we get to depreciate the entire asset. There are, so we all know essentially what depreciation is. In tax, they like to call it cost recovery. So you're slowly recovering the cost that you incurred over the life of the asset. Okay? We have these 4 different components of depreciation that we look at with regard to tax depreciation. First one is the basis. You've heard me use that term a couple of times, basis. Basis is the cost of the asset. So we usually, or book value, what we think of as book value. Now, our basis in an asset gets adjusted over time. It gets adjusted downward for depreciation. So as it depreciates, our basis decreases. It can be adjusted upward as well for improvements in that asset. So we call that adjusted basis. Okay, so over time that basis is going to get adjusted, but when we first purchase an asset or attain it in some other way, that original cost is what we refer to as basis. So that's the first thing, basis. And we're going to go through this stuff in a lot more detail here, each of these components. But remember these. So these are good things to kind of, so we got base. And a marker that doesn't work. First basis. The second thing that we have to consider, so this, we need all 4 of the, we need to know all 4 of these before we can depreciate an asset, okay, for tax purposes. The second one is our depreciation period, otherwise known as asset class lives. So in financial accounting, we get to decide what that life is of our asset, right? We buy a widget maker and we say, okay, this is gonna last us 12 years. So we're gonna use straight line depreciation, we're gonna depreciate it. We've got a $5,000 salvage value that we're estimating. You're using a lot of estimates for financial accounting. This widget maker, we're gonna depreciate it over 12 years. We're gonna, at straight line, we're gonna have a $5,000 salvage value, so this is gonna be our annual depreciation. Well, in tax, we do not get to choose how long we depreciate that item over. Based on the type of asset it is, the IRS determines what that class life is. So, and we have a couple different classifications of assets. We have real property, which is real estate, land, that sort of thing. And then we have personal property, not to be confused with personal use property. Personal use property is property that I'm not using in a business. It's just mine. My personal car, my personal computer, that sort of thing. My kitchen table, that sort of stuff. Personal property, though, is business property that's not real estate. Essentially, every other type of asset that's not real estate is personal property. But these depreciate, and I'm kind of giving you a little preview of this because you'll see when we start talking about the depreciation periods that it matters whether it's real estate or real property or whether it's personal property. We have different depreciation periods for those. So, 2. I'm going to call it asset class lives because that's what the IRS likes to call it. That's the second thing that we have to determine. So the first thing is, what did we pay for it, or what are we using as its basis? And I say that because we can acquire assets in lots of different ways. We could inherit an asset, somebody could give it to us, or we could buy it. There are different ways that we can acquire assets. But once we determine what the cost is of that asset, then we have to look at what type of asset is it. Is it furniture? Is it equipment? Is it software? Is it an agricultural building, which has they've got their own class life? Is it rental real estate? Is it commercial real estate? So all of these things we have to know in order to determine our asset class life, because each of those categories has a different asset class life. Third thing that we have to look at is our depreciation convention. This is the one that's kind of the most foreign to students, is this concept of convention. So when we purchase an asset for financial accounting purposes, when do we start depreciating it? So we got our widget maker. We started using it July 1st. We bought it June 15th, but we started using it July 1st. When do we start depreciating it? When we start using it, okay? So when we put it into use. So July 1st is when we do it. If we started using it July 17th, we'd start our depreciation July 17th. We don't do that with tax depreciation. We don't start depreciating it on the date that we put it into use. We have 3 different choices for when we start depreciating it. These are called depreciation conventions. Okay, so sorry, squeaky. We have the half-year convention, the mid-quarter convention, or the mid-month convention. Now, which convention we use is not our choice. The convention we use is going to depend on what type of asset it is, whether it's real property or personal property. It's also going to depend on when we purchased it, during what period of the year. It also may depend on when we purchased all of our other assets during the year. Okay, so we've got 3 choices. Half year means it's going to be July 1st. Even if we purchased it on December 1st, we're going to start depreciating it July 1st. Mid-quarter means we're going to start depreciating it in the middle of the quarter in which it was purchased. So we purchased it March 15th. The middle of the first quarter would be February 15th. That's when we're going to start depreciating it, even before we even owned it. Right? We start depreciating it. Mid-month means we're going to start depreciating it in the middle of the month in which we put it into use. So we purchase it, put it into use February 7th. We're going to start depreciating it February 15th, the middle of the month. Those are our 3 choices. We don't have any other choices. We don't actually, unless the date that we started using it actually falls on one of those dates. We don't start depreciating it on the date that we actually put it into use. You're shaking your head.
No, I'm just moving it.
Yeah.
I'm thinking that
Okay.
is it like that for all of my assets, or is it per asset?
Well, we'll go through that when we get into we're going to get into details about all 4 of these. Okay. So basis, and again, we have to know all of this stuff. So what we paid for it, what the cost is, what the class life is, what type of asset is it, when did we purchase it, and when did we purchase other assets, and then the 4th one is our depreciation method. Okay, there are 3 options, and sometimes they're not options, but there are 3 different types of depreciation methods in tax. I mean, that's the good part anyway, right? Because in financial accounting, there's just multiple, you can make up your own, right? If it makes sense, you can just make up your own. But in tax, we've got 3 different choices. These are accelerated depreciation methods. 200% or 150% declining balance. You should be familiar with that from principles. I don't know if it's principles 1 or 2, I don't know which one, but you should be familiar with both of those. And intermediate, if you're gonna take intermediate, you'll talk about different depreciation methods as well. Or straight line depreciation. We all like straight line depreciation. That's the easiest, right? We just divide when we're doing straight line depreciation. So you can see here, we not mentioned is salvage value. We have no salvage value. We're gonna depreciate the whole thing. So depreciation method. These are the 4 conventions, or the 4 components, sorry, of depreciation that we're gonna talk about. Basis is probably the easiest. Well, actually, depreciation period is pretty easy once you determine what type of asset it is, because then they just tell you, okay, this is what you're gonna use. This is how long you're gonna depreciate it for. Convention, like I said, this is kind of the most foreign concept, although it's really not that hard to determine once you practice it, once you go through it. When we get to the depreciation method, that's when we're going to start really calculating our depreciation. All right, so what do we have here? How much do we have on this? Can we get through this? Yeah, we could probably get through this. All right. I'm going to start it. These videos take so long to upload. Stop. So if I do it in small